I work in public real estate securities, so very different than some of the other real estate players out there. So for me, what I think is the biggest challenge ahead anyway, is being able to, at the level that we sit as public security investors, properly pricing in the risks, not for individual buildings, but for the portfolio of buildings at an individual stock level, and then further using some additional information, not at property level, but about the corporate wrapper for which these buildings are sitting in. So that's a major challenge where I think the sea change material from ULI is a huge help in doing that. However, it's still a challenge, and the public markets operate in a totally different, sometimes irrational way compared to the private markets. So I think that's one that's I think on everybody's mind, but I think particularly difficult in the public markets. In the US, there's a little bit of tension, I'm sure you're aware of, but we're even hearing, that some of the investors from the other side of the aisle, if you will, rather than asking for sustainability measures, rather are asking for things like, hey, can you please give me a list of every single time that you've invested in a building above and beyond minimum jurisdiction standards, and explain to us why you've done that. So these portfolio managers are sort of feeling this dance between decarbonized and strict, deep interpretation, old-fashioned interpretation of fiduciary duty. For example, with the local law 97 in New York, that is, in the US context, the most stringent in terms of carbon pricing. And we basically did a cash flow analysis. We say, okay, we know precisely what is their carbon intensity today, or let's say last year, end of reporting period, and we know where the hurdle is for local law 97. We know where there are two hurdles, so we know where both of them are, and we know where the distance between their current carbon performance and their expected carbon performance. We also know the carbon tax associated with going above the hurdle, so now we can more directly price that in to the NOI impact and really start to tease out, okay, what is the risk we're talking about? What is the impact that we're talking about in these companies' bottom line? So I think that's one thing that has both answered questions and created more questions. And in terms of answering the additional questions that came out of this, was to understand not just the regulatory impact, but the market impact, because we want to understand, hey, okay, if the regulation only provides marginal effects into the NOI outcomes, what about the market impact? What are tenants willing to do, and how are they going to be part of this story? And what happens there is we did a survey for about 500 corporate occupiers, specifically in office and in New York City. And we wanted to understand, is the bifurcation that we're hearing, is it real, and are tenants willing to pay for it? And we heard a lot of different outcomes, but I think the trend and the theme is, yes, they're willing to pay for it, and they're willing to pay quite a premium for it. And they directly answer this in the way that they contextualize and they make their leasing decisions. So regulatory, market, put it together, and we have our answer in terms of financial impact. What we wanted to do was take our own accountability very serious, and our accountability comes from where do we place our assets. So we decided by 2025, 60% of our assets under management for real estate, both public and private, need to be in companies and funds that set a science-based target. And then by 2030, that means that goes to 100%. And further, it doesn't just say a target, it becomes enshrined in our mandate documentation, meaning that it's a minimum eligibility criteria to be, for us to provide capital to these investments. So yeah, we hope that starts to really stimulate the change that we're looking for, because it's very concrete in what we're asking.